think it's too late to start investing at 40. Let me prove you wrong. The truth is 40 is not the end. It's actually one of the best times to start investing, to build wealth. Today, I'm going to show you the late starters plan to start serious wealth. And even if you are behind, I'm in my 40s, and I'm proof that you can also invest. I started investing years ago. Don't think that you're behind, because you're not. You just start a little later than others. I'm DG, the Cultivated Money Coach, and I'm all about helping you to master your finances. Let's dive into the conversation. Listen, I get it. You see people online talking about how they started investing at 22 years old, and you're thinking, well, I missed my chance. Not too late. No, you haven't missed your chance. In fact, that comparison will rob you of your future, and if you let it, the reality is, yes, you might have lost some time, but you've gained something even more powerful. Wisdom, stability, and even, in some cases, higher incomes. And that means you can catch up even faster when you think about it. Here's the drill. I'm going to break down the reality that you need to realize when it comes to your situation. Because you're 40 years old or older doesn't mean that your life for investing is over. Time isn't everything. It's important, but money grows faster when you can put it in an investment account or retirement account consistently. Even at 40, you can still save for retirement. And compound interest, which is the vehicle that grows your money when you invest in it, it still works for you. And even with 20 years left, your money can even increase multiple times before you retire if you invest the smart way. Fear is the biggest blocker that's stopping you and others like you from investing. Most never start because they think they're too old or too late to start investing. That fear costs more than any missed years. So don't let the fear stop you from investing. And some of you may be even not educated enough. You feel like you don't know enough. That's fine, but learn some information to help you to know about investing. Learn about financial literacy, learn about stocks, bonds, mutual funds, all things investing related, so that you can have an understanding of what investing is and how your money can grow, even if you start investing a little bit. So here's your step-by-step, a late starter plan. The first step is to open a Roth IRA or a brokerage account. I recommend doing a Roth IRA first. Basically, a Roth IRA allows your money to grow tax-free. So you invest money that you earn, so you take home pay, you invest it in a retirement account, a Roth IRA, and it grows tax-free. That means you already paid taxes on the money that you earned, and you put the money into the Roth IRA, and your balance goes over time. You can take the money out of your account when you retire, that is. You basically won't pay tax on that money because it's already been taxed. So you're investing with after-tax dollars, which is a great opportunity. Now, a brokerage account is an account you can create. So you may go to Charles Schwab or one of the companies, say Fidelity, and open up an account. And I recommend if you do this route, invest in at least 25 stocks or more. I say stocks, not bonds, because stocks over time outperform bonds. And in fact, the stock market has averaged about 10% on return on people's investments over time since it started. So I recommend if you're going to invest in stocks, get at least 25 stocks and diversify your portfolio. That means get stocks in different industries. That way, if one industry isn't doing well, hopefully another one would do pretty good and offset your losses. You don't want to put all your stocks in the same industry like tech or healthcare. You want to have some tech, healthcare, maybe some consumer goods, but you want to make sure you have investments that are diversified. That means they are able to offset each other if one industry is doing well and the other one isn't. Again, that way you won't lose all your investments, because investing is risky. And the one way to offset investment risk is through diversification. Step number 2 is to invest in some things such as mutual funds, because a mutual fund is basically the same thing like I mentioned earlier with brokerage accounts. You're putting your money into a fund, and it has, in this particular case, 200 stocks or more. It'll have more than 25 stocks, and it's in different companies in the U.S. If you get a traditional mutual fund, such as a growth stock mutual fund, which is basically investing in stocks that grow over time, and they're all stocks that are in the U.S. Now, if you get a mutual fund that is international, you're going to get a portfolio with stocks in it that are outside of the U.S., which is good because you want to have some diversification, which is what I discussed earlier. So start with something simple. A mutual fund is simple, where it's a pool of stocks that someone manages for you, and you basically have a fund advisor. They're managing your fund for you, and you have a stockbroker, and they're the middle person between the company that has the investments, right? And then they buy them on your behalf. Now, it's good that you are educated enough to know what kind of stocks you want to buy. Your financial advisor will advise you, but it's up to you to actually make the decision on the kind of stocks you want to have in your portfolio, basically. Well, in the mutual fund. So if you want to do growth stock mutual funds, or you can do growth and income mutual funds, you can do aggressive growth mutual funds, or you can do international. Those are the four that I recommend. But again, learn about those so you'll be able to understand what you're buying within the mutual funds. The third one is to automate your investing. That means you want to set it up on autopilot. Learn about investments, set up an account, brokerage, or mutual funds, our Roth IRA, which has mutual funds within it. Or you do the brokerage account, make sure you pick stocks that are going to be advantageous to your retirement. And then you want to set up on autopilot so that you can continually invest over time consistently. You don't want to invest and then do it every now and again. You want to do it consistently so your balance can grow, so you can hopefully have retirement, even in your 40s, that you can be able to at least relax and say, all right, this is it. This is where I want to be. I didn't invest earlier, but I'm comfortable with where I have put into my account, and I'm able to live on that. Step number 4 is to increase your contributions every year. By doing that, adding an extra $100 or $200 every month can help make changes in what you have invested when you retire. So even if you start late, the whole point is you want to start the process. You're not too late, but the longer you wait, the harder it gets to start. So start small, start today, start scared if you have to, but the whole point is to start. And if you're ready to begin wealth building at 40, type below wealth builder 40 in the comments. And sis, if you found this to be helpful, hit the subscribe button and share this video with other black women who they think it's too late, because we are building wealth together.